going to be one or two winners in each category of coin, right? In Bitcoin, you've got MicroStrategy. It's kind of hard to come in and do a Bitcoin DAT and beat MicroStrategy. I know that there's been the Block 1-1 and a few others and the Nakamoto. But yeah, it's going to be very hard to upset Michael Saylor. So it's a game of size and scale and distribution. And this is what Michael Saylor has showed us, is that you have a universe of underperforming money managers or indices that want the Bitcoin risk, that amazing volatility adjusted performance, but are not allowed to buy Bitcoin ETFs because they're considered usually currencies or commodities, and that's not within their mandate. They're not allowed to buy Bitcoin and custody it themselves because that's just not what they do as a money manager. So they can only buy public equity companies.
Bitcoin doesn't just outperform, it leaves everything else in the dust. That's Arthur Hayes' point. When you strip away the illusion of dollar pricing and measure assets against something real, the story changes. Stocks, housing, even the big-name tech companies look strong in dollar terms. But price them in gold, and most haven't fully recovered from the 2008 crisis. Price them in Bitcoin, and they nearly disappear from the chart. The performance gap is that massive. Hayes says both Wall Street and crypto traders are betting on the same truth. Central banks will always print. When they do, traditional finance piles into leveraged bond trades because that's the game they know. Crypto investors, meanwhile, just choose Bitcoin, the faster horse in the same race. On the corporate side, Hayes points to the playbook pioneered by Michael Saylor and MicroStrategy. By using debt and then equity, Saylor leveraged his company's rising stock price into a perpetual Bitcoin accumulation machine. The higher the stock goes, the more capital he can raise, which buys more Bitcoin, which attracts more institutional interest. It's a feedback loop. Hayes says this works because big funds often can't buy raw Bitcoin or even ETFs due to mandate restrictions, but they can buy stock in a listed company holding Bitcoin. That opens the floodgates. Still, Hayes warns there won't be dozens of winners. In categories like miners, infrastructure firms, or Layer 1 blockchains, only one or two dominant players are likely to survive the coming consolidation. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Bitcoin is the best performing asset when you think about currency debasement ever, right? Okay, yes, the S&P 500 is up in dollar terms, but deflate that by gold. Since 2009, the S&P has not recovered its gold price from 2008. Deflate the housing market by gold, again, and not anywhere close to where it was. Tech stocks are probably one of the only things that have, big US tech is probably one of the only things that's done well, deflated by gold. If you deflate things by Bitcoin, it's not even, you can't even see it on the chart. It's just so ridiculous about how well Bitcoin has performed. So, I got asked this question, like, why is there a difference between TradFi and crypto? There's not. Actually, when you talk to a TradFi person and sort of really get down to what they believe, what do they believe? They believe the same things that we believe. They believe that, when something happens, the Fed, the Treasury, the BOJ, the ECB, the PBOC, the SNB, they will print money. And what happens when they print money? They buy bonds. So in their mind, because they know bonds and they did a CFA or they went to business school, okay, well, if I buy the 10-year at 5% and it goes to 4% and I lever that 30 times, I become Ray Dalio, right? That's their mind. That's all he fucking did. He went long the fucking 30-year bond on leverage. That is interest rate parity. I can't fucking shit on him. Good on you. For running that fucking trade, but that's the trade. We all believe in the same things. It's just that crypto is the faster horse. Bitcoin has been the best performing asset on this currency debasement theme across any asset class. So it's not that we have a difference of opinion. We believe the same things. We believe the money will be printed. It's just that we in crypto choose an asset that performs better. And so if you take a very short time horizon, like, I don't know, from a couple months ago, and you say, oh, why isn't Bitcoin at 150,000? Well, I'm sorry that you bought Bitcoin 6 months ago, but for anyone who bought it 2, 3, 5, 10 years ago, they're laughing. Like, I don't give a fuck, right? I have so much outperformed the debasement of the dollar and every other fiat currency. Like, why am I being all moody that, Bitcoin is not, hitting a new all-time high every day? It doesn't matter that the S&P is at 6,700 or whatever it is. It's still down in gold terms from the crisis. So I think people need to readjust their perspective on this. If you thought that you were going to buy Bitcoin and the next day you were buying a Lamborghini, you're probably getting liquidated because it's just not the right way to think about things. There's going to be one or two winners in each category of coin, right? In Bitcoin, you've got MicroStrategy. It's kind of hard to come in and do a Bitcoin DAT and beat MicroStrategy. I know that there's been the Block 1-1 and a few others and the Nakamoto. But yeah, it's going to be very hard to upset Michael Saylor. And then you have sort of the Bitmain and those in the East space, obviously Upexi and some others in the Solana space, and pick your fucking shitcoin, and there's going to be a DAT on that. So the question for you as an investor is, okay, basically what they're doing is corporate finance alchemy. If I can get my stock price high enough, the market cap high enough, if I can get my trading volume high enough, then there opens up all these institutional investors who are allowed to buy the debt and equity derivatives that I can sell. And the higher value of my stock, the more crazy shit that I can offer, which basically allows me to, positively accrete Bitcoin or some other shitcoin on my balance sheet and thus benefit equity investors. So it's a game of size and scale and distribution. And this is what Michael Saylor has showed us, is that you have a universe of underperforming money managers or indices that want the Bitcoin risk, that amazing volatility adjusted performance, but are not allowed to buy Bitcoin ETFs because they're considered usually currencies or commodities, and that's not within their mandate. They're not allowed to buy Bitcoin and custody it themselves because that's just not what they do as a money manager. So they can only buy public equity companies. And so if you're able to pitch them a public equity company, but has this crypto underlying, then they'll buy whatever you're selling and they'll pay $2 for $1 or $3 for $1 or $10 for $1, whatever. They don't give a fuck, right? They're just following rules. And so that's the game, but it's a game of scale. And there's only going to be one or two per each category. And then obviously, as we progress further in the cycle, the newer issuers are going to resort to riskier forms of corporate financial derivatives to generate positive equity price performance. And that's what will get people into trouble when the prices start falling.
Arthur Hayes sees the Fed's resistance crumbling bit by bit. 4 months they've dragged their feet, but by next year the direction looks obvious. Rate cuts, balance sheet tricks, and fresh liquidity injections. Hayes says Trump could accelerate the process by reshaping the Fed's levers, adjusting how reserves work, opening up the discount window, and even freeing institutions like Fannie Mae and Freddie Mac from conservatorship. If that happens, those mortgage giants could unleash trillions into the housing market, letting Americans once again borrow heavily against their homes. The playbook hasn't changed in decades. When consumers run out of cash, the system turns them toward credit. Lower rates make borrowing easier, and suddenly money starts moving again. People take out loans, buy houses, upgrade cars, pile into stocks, anything that looks like an asset. The real economy doesn't necessarily get healthier, but liquidity swells anyway. Hayes argues that this new flood of credit won't just chase housing or equities. Some of it will inevitably spill into Bitcoin. In fact, Bitcoin thrives in precisely this kind of environment, when central banks choose stimulus over restraint and consumers are encouraged to spend borrowed money. The irony, Hayes suggests, is that even as the economy struggles, the policy response could light a fire under Bitcoin's next big leg higher. Let's get back to the interview.
I think we're starting to get to the real meat of the cycle, middle of the cycle, because if you think about, Trump's a new president. Obviously, it's a second term after the Biden administration, and his first term, he's a very populist president. He did the biggest sort of handout to American people since Andrew Jackson with or probably LBJ with sort of the COVID stimulus checks, right? That's not a very, traditional Republican sort of measure to basically say, let's just hand out money to people, make sure that they stop bitching while we lock them in their house for the flu. And so when that happened, he is, bona fide credentials as a person he wants to win elections. He doesn't have ideology behind it. So winning elections means providing free shit to people. He provided the free shit during COVID. He provided the free shit in 2017 with one of the largest tax cuts ever in American history. And he's going to provide more free shit. Otherwise, him and his, Trumpian Republicans are going to get voted out of office in 2026 and then in 2028 in the presidential election. So I think he knows exactly what he needs to do, which is provide free shit and print money. And that's what he's going to do. And now, obviously, the Fed and certain individuals within sort of the bureaucracy that is the American government have been sort of stymieing his efforts. But, domino after domino is being knocked down. And, by, middle of next year, it's going to be full steam ahead in terms of the Fed's on board, no more Powell. Maybe he's got 4 out of 7 Fed governors and he can do some other funky things with the interest on reserves or the discount window. And you have Bessent doing these sovereign wealth fund deals. You have possibly Fannie and Freddie ending conservatorship, and now they can lever their balance sheets and add about $4 to $5 trillion into the mortgage markets, allowing people to re-leverage on their houses. So yes, if the consumer runs out of cash, what does the American consumer do when they don't have money? They borrow it. And so if I reduce the cost of money, then you can borrow more. And so I think that's why the price of money in this instance matters. I'm more of a quantity of money guy, but I can see that. Yeah, okay, you can say the American consumer is tapped out. The housing market's a bit overbought. Well, if I cut rates from 4.5 to 2, well, then you're going to take more leverage and buy more stocks, and max out that credit card and buy a new car and take out a home equity loan. So I think that's a very short-sighted sort of explanation. If you sort of believe that the Fed's going to start cutting rates and Trump is going to unlock all this liquidity on Fed balance sheets, the mortgage market, and another thing that people are not really paying attention to is Wells Fargo has just been paroled out of jail. They were not allowed to increase their balance sheet for many years after the whole fiasco that the criminal sort of customer shit that they did back. I don't remember exactly what it was, but I think in middle of June or early July of this year, they were finally allowed to increase their balance sheet. There's a very famous macro analyst, Zoltan Pazar, who estimates that they have about $450 to $500 billion of capacity in the balance sheet to buy treasuries and other debt securities now that they can grow their asset base. And so you have another liquidity engine in the commercial banking system in the United States. So I don't really care a fuck about the real economy. All I care about is the credit, and the credit's going to flow, and it's going to flow into Bitcoin.
What emerges from this picture is a clash between old mechanics and new momentum. The legacy system leans on familiar levers, cheaper credit, fresh liquidity, and the recycling of debt into more borrowing, while a parallel arena is being energized by scarcity and digital resilience. The contrast is stark. Established markets rely on engineered stability, yet their strength looks fragile once measured against assets built outside of central bank control. Momentum is gathering behind the idea that not every sector or player will thrive in this reshuffle. Instead, leadership will likely condense around a handful of dominant forces capable of channeling both institutional capital and retail conviction. The broader consequence is that financial power may no longer flow through the same arteries it has for generations, but through a system redefined by technology and scarcity-driven trust. The pressing issue now is whether this shift unfolds gradually under the surface, or whether a sudden break in confidence will accelerate the migration of wealth into digital stores of value. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.